Hey everyone, in today's video, we are going to reverse engineer the retirement. Instead of asking, how much do I need to save? We are asking the question, how many rental properties do I need for me to never work again? I'll show you the exact calculations that we use in real time for 2025 data. The numbers are going to challenge everything that you think about retirement planning. Hey everyone, welcome back to the channel. I'm Oksan Reza. I am your property mentor. Over the years, I've built multi-million-dollar property portfolio and helped clients with developments that have delivered seven-figure returns. Now, by the end of this video, you'll have a really clear roadmap for exactly what property portfolio needs to look like when you're ready to retire. The Association of Super Funds of Australia has calculated that for comfortable retirement in 2025, you need a single person needing $52,000 per year, or a couple needing $73,000 or $74,000 per year. Now, here's the key insight. Retirement isn't about accumulating a massive sum and hoping that it lasts. It's about creating enough passive income to cover these annual expenses. That's where the property investing comes in. Now, most of the times what people think about retiring is they go around thinking that I need to build this wealth. And so most people, when they retire based on the massive money that sits or locks it into the property, which is not ready for them to give the passive income. Let's start with the conservative approach, okay? Using properties that delivers the national average yield. We are going to use a median capital city property worth $750,000 as an example. Now, the property value is $750,000, gross yield of, let's presume worst case scenario, 3.74%. Annual gross rental yield is roughly around $28,000. Let's subtract these expenses. Annual gross rent, $28,000, less expenses at say 25%, $7,000. Net annual income per property is $21,000. So you would need 3 properties to cover a comfortable retirement. A couple would need 4 properties. But wait, let's think about this for a moment. 3 properties worth $750,000 each means you're looking at $2.25 million in property value. That's substantial property portfolio, and you might be thinking, how on earth do I get there? Now, here is where it gets really exciting. You don't need to buy these 3 properties outright. Even with a 20% deposit strategy, you're looking at $150,000 per property, or $450,000 in total deposit. Still significant, but far more achievable when you consider it. Your current home equity can be leveraged, and the capital growth over time reduces your effective cost basis. The rental income comes in to help you service the mortgage. Now, let's look at the high yielding strategy. This is where things get really interesting. We are talking about regional property markets. We're talking about towns like Gladstone, Mackay, Cairns, or even some of the mining towns where yields are significantly higher. Our example for $500,000 regional property earning 6% gross yield, annual gross rent is roughly around $30,000. After expenses, again, 25%, $7,500 net income per property comes to about $22,500. So a couple would need 4 properties, but they would actually be generating about $90,000 per year, giving them a buffer above the comfortable retirement threshold. Here's the reality check. What's really compelling about the regional strategy? Number 8, the lower entry cost points. You need only $100,000 deposit instead of $150,000. Higher yield. Your money is working harder for you. Often stronger rental demand due to limited supply offers in some of these areas. Now, the total portfolio value needed is only $1.5 million versus the $2.25 million that you were originally looking at. Now, what's the trade-off? The regional properties can be more volatile. You're betting on the long-term sustainability of these regional economic infrastructure hubs. But with Australia's ongoing decentralization trends and infrastructure investments, many of these regional areas would look interestingly and increasingly attractive. Now, before you rush out and start buying these properties, we need to talk about the factors that could make or break your strategy, because it's not always rosy on one side of the equation. Let's talk about mortgages and leverages. Most investors don't buy properties outright. They use mortgages, and here is how that changes the maths completely. If you have $150,000 as a deposit on $750,000 property, your loan sits at about $600,000. At interest rate of today at 6.5%, that's $39,000 per year. Net rental income of $21,000. You take the $39,000 of interest, and hey, reality check, $17,000 negative per year. That's right, you are negatively geared. This property costs you money each year, but you're banking on capital growth and tax benefits to make it worthwhile. What are the tax implications? Property investing isn't just about the rental income. You've got negative gearing tax benefits, depreciation deductions, capital gains tax, land tax thresholds that you need to care about in most states. These can significantly impact your actual returns. So the risk factor in property isn't a guaranteed investment. Consider, vacancy periods could be longer than expected. Major maintenance work could come in, like you need a new roof or a new air conditioning unit, or the interest rate changes that can affect the servicing or the market cycle timings, that can affect both the rent and the value. But here is the positive side. Property values typically grow over time. If your property appreciates at, let's say, 4% annually, a $750,000 property becomes $1.1 million after 10 years. This capital growth can be accessed through refinancing or selling or providing additional retirement funding. So how do you actually get there is the question. Let's map it out so that you can get a realistic timeline from today's conversation. Your starting point: own your own home with some equity. Timeline, let's say 10 to 15 years towards the retirement. The year 1 to 3 is where you would buy your first investment property. You're using your home equity for deposit. You choose a strategy of average yield city or higher yield regional city. Either or is fine. Focus on cash flow positive or neutral properties. You can't go down the path of negatively geared properties at this given point in time. Year 4 and year 5 is where you're adding the second and the third property. Again, you're using the equity from the first property plus the capital growth, and you're rinsing and repeating the process. Between year 8 and year 12, this is what completes your property portfolio. You're possibly adding a fourth property, focusing on optimizing yields and reducing debt. Now, what happens is you are going down the path of pre-retirement or consolidation exercise in the last 2 years, where you are paying down the mortgages to improve your cash flow. You are considering selling one or more of the properties to eliminate debt on others. Fine-tuning property portfolios for maximum passive income is the key. The key is starting early enough to let the compound growth work in your favor, both in the capital appreciation and in building equity to fund subsequent purchases. This is pure strategy, which is outside super. If you're considering to do this in super or superannuation or SMSF funds, the strategy would significantly be different. And it also depends on how far are you from your preservation age, which is 60 years today. But that is the story for another day. Now, if you found this breakdown helpful, make sure to subscribe and hit that bell icon. I would love to hear it in your comments. Are you planning to use property to fund your retirements? And if so, what strategy appeals to you more? The conservative city approach or the high-yielding regional strategy approach? Next week, we are diving into the tax implications of property investing and how to structure your property portfolio for maximum tax efficiency. Till then, take care, keep smiling, keep investing. This is Moss checking out. Adios.